Hello and welcome to your daily note for May the 25th, 2022. So the data that we got yesterday was the Global Purchasing Manufacturing Index, both for services and manufacturing sectors. When we dig into it, you're going to notice that the actual report came in under the forecasted estimates, and it also came in under the prior month. We also got new home sales, which also declined, and we're going to dig into that as well as how the market's currently pricing this information. So let's start with the PMI. So the Composite Pmi Index, which combines services and manufacturers, did continue to slow down. April registered at 56, coming in at 53.8 here. Moving on to services, 55.6 versus 53.5, and moving to manufacturing, 57.5 versus 59.2. And I want to highlight here 3-month low, 4-month low, 4-month low. So what you're going to notice is a continuing weakening of PMIs. So this weakened rate of expansion of output across private sector firms is the lowest that we've seen in the last 4 months. The rate of growth was the softest for the 4-month period, with the index now below the series long run average of 54.8. At the same time, new orders across the private sector continued to increase during May, albeit at a softer pace since August of 2020. The rise in new sales was driven by manufacturing firms who recorded a sharp uptick in client demand, despite the rate of growth softening again from March recent highs. Service producers, however, signaled the slowest upturn in new business for almost 2 years, as hikes in selling prices weighed on demand conditions and the initial boost to demand from the reopening of the economy. Another key point that we've been making is input costs. So we've been talking a lot about inflation and about how we really need relief in the inflation rate to not only give the economy relief, but also more likely probably giving the stock market relief as well. So input prices continued to soar higher, with the pace of increasing edging up to a new series high since October 2009. Firms reported a substantial uptick in cost burdens, largely driven by a record-breaking rise in service sector input prices. The rate of cost inflation at manufacturers also accelerated and was among the fastest in the series. The surge in input prices was linked by companies to supplier-driven price hikes for a wide variety of goods and services as the demand continued to outstrip supply, as well as higher interest rate, wage bills, fuel cost, and higher transportation fees. So I'm going to pause here for just a second. These higher input prices are going to continue to put upward pressure on the PPI, which is the producer price index, and that feed-through mechanism from the PPI to the CPI, or the consumer price index, most likely will continue. And I think until we see the purchaser's price index start to subside and get these input costs coming down, I think it's likely that you're going to continue to see sticky CPI. So concurrently, firms continue to raise employment levels midway through the second quarter and at the fastest pace for 13 months. So this speaks to Jerome Powell's point that unemployment and the jobs market remains extremely strong. Business confidence among the private sector remain upbeat, with firms recording a stronger degree of optimism in the outlook for output over the coming year in May. And firms were buoyed by ongoing sales growth and investment in local supply chains, which it hoped will ease some of these bottlenecks. However, although higher than April, the degree of positive sentiment was below levels seen earlier in the year amid concerns regarding inflation and customer spending patterns. So sentiment may be reaching a plateau as more and more people are worried about demand destruction. I think comments from Chris Williams, which is the chief business economist at S&P Global Market Intelligence, he probably points this out better than anybody, but the early survey data for May indicates the recent economic growth spurt has lost further momentum. We've been citing that really since late spring, early summer of last year, that the economy on its early indicators were already slowing down as the inflation rate really started to accelerate and pick up. What you're seeing now is kind of this rollover, and you're going to see it a little bit in the new home sales data when we look at that. But really, as this pent-up demand starts to wane, you're going to see the demand continue to come under pressure from these cost of living adjustments, these higher interest rates, and just the broader slowdown in the economy. One of the things he does note, however, is despite all of these headwinds facing businesses, the survey data remains indicative of the economic growth to continue to have an annual rate of roughly 2%. The key thing here is even though that it's going to have an annual rate of 2%, that is still significantly slower than what we've been experiencing, and that highlights the continued slowdown here. So continued to highlighting slowing demand, dragging down PMIs, and higher input cost, I think is the ultimate conclusion to the PMI report that was released yesterday. Add that to another list of slowing economic data. This is another piece of information that continues to show slowing economic data, and it's the monthly new residential home sales. So monthly new residential home sales, we did see 16.6% below the March rate, and that's 26.9% below the April 2021 estimate of 809,000. If we actually come in here and we look at the trend rate of new home sales versus the actual new home sales data, you're starting to see the trend flatline as it's done in previous cycle peaks. And that's because this hard reduction from the top that we've seen just a few short months ago, back at the end of last year, has really rolled over hard and is really starting to show this demand struggle here. And it's because not only one, have interest rates started to rise, and that's making home buying a little bit more unaffordable, but you've also seen sell prices rise. So if I could come down here for a second and look at sell prices with you for just a second, you're going to see that sell prices went from 376 in April all the way up to 450,000 today, and that's despite this slowing in new home sales and despite the fact that the month of supply continues to drive higher. So if you're looking at April 2021, there was only 4.7 months of supply on the market. Today, there's roughly 9 months of supply on the market, which is almost a 91% increase of supply of homes available for sale. And I drew a small, supply and demand diagram here real quickly. What you're seeing is demand destruction as those interest rates go up, and as buyers kind of step out of the market, as you're seeing the new home sales come down, but you're also seeing supply increase as well. Resulting in a situation where ultimately we're going to have to see those prices of homes start to come down as more homes set on the market, and prices, of course, are going to have to meet that new level of decreased demand. So it's likely we're going to see home prices starting to peak as more and more supply comes to market. So add that to another list of data points that continue to break down. You're going to get more data. This durable goods orders are coming out today. The FOMC minutes are coming out. Then you get into initial jobless claims, corporate profits, pending home sales, personal spending and income, and retail inventory. So there's a lot of information coming out the rest of the week that's going to highlight more economic data, but it continues to put us in the same camp that with economic data slowing and the Federal Reserve continuing to remove support, you're continuing to get the stock market in this tailspin sell-off. In fact, when we look at the year-to-date numbers, the triple Qs being down roughly 30%, or growth being down roughly 29%, versus defensive and value being down single digits, down 9.7 or down 8.5%. Dividend payers are down 3.9, low volatility is down 5, or high volatility or high beta is down 24. You are getting some relief in those extremely defensive sectors, so I think that's a really interesting sign here. As the market continues to pivot and continues to shift more and more defensively, as it's going to take time for this demand destruction to work through, and it's going to take time for the Fed to normalize their interest rate policy and their quantitative tightening. That's what we're seeing here. I did add something new to our quantitative tightening Fed Watch graph here. I'm under the impression that, the Fed is going to roll off the balance sheet all the way up to the red line in currency and circulation, which is roughly $2.3, $2.4 trillion versus where they are right now, which is roughly at $3 trillion. They just released a paper from the New York Fed, and I saw this on Twitter, that they believe that the ample reserves that need to remain in the system, or the quote-unquote floor of reserves, should be 8% of GDP. I believe that's a little low. I think currency and circulation might potentially be a better floor. But if it's 8% of GDP, you're looking at roughly 1.8, 1.9 trillion there. As it's going to be dependent upon how GDP continues to trend here. If GDP starts to trend lower, I think that'll be interesting. But regardless, adding that to the chart here for an additional tracking of when the Fed might stop quantitative tightening, and I think it could be this breaking point of when the green line starts to move through the currency and circulation. Square that with their interest rate policy. They're going to continue, I believe, to just march up to expectations. That's what they did in the previous tightening cycle. They marched right up to where the 2-year was at that time, before the 2-year really started to roll over hard. And then they pivoted pretty quickly. So I think they're going to continue to do that here. They're going to continue to march up to where market's expectations are. And really, it's been orderly. I mean, when you look at the VIX or volatility coming down, even though this sell-off has been extreme, it's been somewhat of an orderly sell-off. And it's probably because all of this has been talked about and been anticipated. We knew the Fed was going to tighten to fight inflation. I think the only unanticipated situation that's come through is Russia invading Ukraine, and that really created volatility just in that February-March period. Everything else, I think, has been kind of this slow bleed as we're all trying to reprice expectations, try to understand where the turning point of inflation is. And so it's kind of this slow liquidation, so to speak. So because of that, you're going to see our daily optimized portfolio continue to highlight more defensionary stance, U.S. Treasuries and the fixed income, alternatives being like silver, gold, and holding a little bit more cash, and then low beta dividend payers, quality, defensive, and value, I think, continue to be the equity positions you want to hold on to there. I think that's a great place for us to stop as we're waiting for more economic data to come out. But we cannot pivot until we get more positive economic data. And unfortunately, what we're seeing when we run a trend of the data that's coming out, when we're reading the reports, I think you're continuing to get a flavor of this demand destruction and this slowdown in the economy. So stick with us as we continue to get more of that, and we'll continue to bring that and update you as we go along the way. If you have any questions at all, leave us a comment, shoot us an email. We'll be happy to answer those for you, and we'll be back again tomorrow with another update.